99% of people who invest in crypto end up losing all of their money. It's not because the game is rigged, and it's not because they're unlucky. It's because they fall into these same traps that repeat every single cycle. If you don't learn how to avoid them, 2025 will be no different. My name is Danilo, and today I'm breaking down the 7 biggest mistakes I see investors making right now. More importantly, I'll show you how to sidestep them so you're not left holding the bag when the markets turn. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. One of the biggest traps I see in every single bull run is people piling into a narrative after it's already run its course. Crypto doesn't move in one giant wave where everything pumps together. It moves in many seasons. Maybe AI coins lead for a few months, then DeFi catches some fire, then meme coins or gaming tokens take their turn. And if you only show up when Twitter is already screaming about 10x gains, you're usually too late. I've seen it happen over and over again. Last cycle, people only started buying Solana after it had already ripped from $20 to $200. The early movers did make life-changing returns, while the latecomers ended up holding the bag when the momentum cooled off. That exact same dynamic is playing out right now, with new narratives like real-world assets and meme trading platforms. And if you chase after the hype once it's obvious, you're effectively buying someone else's exit. So, how do you exactly avoid this mistake? The key is to diversify across narratives and position early, even if you're not sure which one will run next. Have some exposure to sectors like DeFi, gaming, RWAs, and memes so that whenever a tide comes in, at least part of your portfolio rises with it. That way, you're riding the wave instead of drowning in all the FOMO. Another mistake I see beginners make all the time is judging a coin by its price instead of its market cap. On the surface, it feels like buying a token that costs a fraction of a cent is a massive steal. People think, if this coin just goes to $1, I'll be rich. But that's not exactly how crypto valuations work. Market cap is what actually matters because it measures the total value of a coin. You calculate it by multiplying the price by the circulating supply. That one step changes everything. A token that trades for less than a penny but has trillions of units in circulation could already be worth billions. In that case, expecting to hit $1 isn't really realistic. It would need to surpass the size of entire industries. A good example is Shiba Inu. Back in 2021, investors rushed in because they could buy millions of tokens for next to nothing. On paper, it felt like a sure thing. But the market cap was already massive, which meant the upside was limited compared to newer coins with smaller caps. In contrast, look at Bonk on Solana. When it launched, it was also dirt cheap per token, but the market cap was a fraction of Shiba's. That's the difference in why Bonk had far more room to move, and it actually did put up some serious returns for early holders. The lesson here is actually quite simple. Stop focusing on how many tokens you can buy and start focusing on the total value of the project. Market cap tells you how much room there is to grow. If you want to avoid getting stuck in dead-end plays, always ask yourself, what's the market cap today, and is it realistic for this project to double or triple from here? That mindset alone will save you from chasing coins that look cheap but are already tapped out. The next mistake is assuming your funds are safe just because they're on a big exchange. FTX proved that wrong in the most brutal way possible. Millions of people woke up one morning in 2022 to find their accounts frozen, billions vanished overnight, and years of savings gone. For many, that was the hard way to learn that if you don't hold the keys, you don't truly own your coins. And here's the thing, even after FTX, people are still making the exact same mistake. In 2025, exchanges are under more pressure than ever. The US passed the Genius Act, which forces stablecoin issuers and platforms to comply with strict rules. That might sound like good progress, but it also means sudden changes. Frozen accounts or mandatory KYC updates can hit without warning. If all of your funds are locked in one exchange, you're exposed to risks that have nothing to do with the market. So, what should you actually do? For the coins you plan to hold long term, get a hardware wallet. That one move puts your assets beyond the reach of exchange failures, hacks, or regulators. For trading capital, spread it out. Don't keep everything on Binance, Coinbase, or any single platform. Use 2 or 3 and treat exchanges as places to trade, not to store your net worth. The fourth mistake is writing your winners all the way up and then all the way back down. It feels amazing when your portfolio is pumping. Every refresh of your app makes you feel like a genius. That's when the greed creeps in. You convince yourself it's going higher. You hold just a little bit longer, and before you know it, all your gains disappear. Doge in 2021 is the perfect example. When Elon Musk was tweeting about it, Dogecoin hit 70 cents and people genuinely thought a dollar was next. But the hype cooled and Doge crashed back under 10 cents. Anyone who didn't sell along the way ended up right back where they started, or frankly worse. And that story has repeated multiple times with countless tokens. The truth is, you don't need to nail the exact top to win in crypto. In fact, the most successful investors rarely do. What they do instead is sell in stages. Maybe you take 10% off the table when a coin doubles from your entry, another 10% at 3 times gain, another slice after that. It doesn't just lock in profits, but it also takes the emotions out of your selling, because the plan is already set. This is where people underestimate the math. Even pulling out a portion of gains during a run can change everything. You get your initial investment back, you de-risk some of your portfolio, and you still leave room for more upside. That way, no matter what happens next, you're in a stronger position than the person who's holding and praying. The fifth mistake is trusting someone else's conviction instead of building your own thesis. Social media makes this really tempting. You'll see the YouTubers, Twitter gurus, or even celebrities talking about the coin that's the next big thing. The problem is, you don't know their incentives. They might have been paid to promote it. They might be unloading their bags while encouraging others to buy. Or they might just be guessing with no more insight than you have. We've seen this play out before. Entire communities piled into influencer-backed tokens that looked unstoppable for a few weeks. Then the liquidity dried up, the hype faded, and those coins collapsed to almost nothing. The early promoters walked away with millions, while everyone else was left holding worthless tokens. The sad part is that this isn't rare. It happens every single cycle, just with new faces and new logos. The real danger here isn't just losing money on one single bad play. It's the habit of outsourcing your decision making. If you don't understand why you're in a position, you won't know when to get out. That's why people freeze when prices fall. They weren't investing with the conviction they had, rather, they were renting someone else's. The fifth is simple but yet powerful. Do your own research before putting money in. That doesn't mean you need to spend 10 hours reading boring white papers. It means checking the basics: market cap, token distribution, team credibility, actual product. A quick 30 minutes of your own digging will put you miles ahead of people who just buy because an influencer said so. The sixth mistake is betting too much on one idea and expecting it to turn into a guaranteed ticket to financial freedom. Every cycle, there are stories of people going all in on a single project because they were convinced it couldn't fail. Terra and Luna are the clearest examples. For a while, it was marketed as a safe place to park your money with 20% yields. It looked like free money, so people put their entire savings into it. When the system collapsed, billions of dollars were wiped out in days, and many retail investors were left with nothing. Now, that is an extreme case, but the same mentality shows up in smaller ways all the time. Maybe someone puts half their portfolio into one meme coin, thinking it will 100x. Or they chase leverage on an exchange because they're sure the market is about to rip higher. When it works, the upside feels incredible. But when it doesn't, a single bad trade can undo months or even years of progress. The truth is, crypto can deliver life-changing returns, but not if you treat it like a lottery ticket. A better approach is to spread risk across different narratives and set personal rules for allocation. For example, you might decide no single coin ever makes up more than 10 or 15% of your portfolio. That way, even if one play goes to zero, you're still in the game. Having realistic expectations is just as important. Not every coin will 100x, and not every trend will last. If you go in thinking you'll get rich overnight, you're setting yourself up for disappointment. But if you focus on stacking consistent wins, managing your risk, and surviving the inevitable pullbacks, you'll be in a much stronger position to actually benefit from the bull run. The last mistake is focusing only on individual coins and forgetting that crypto doesn't just exist in a vacuum. At the end of the day, this market is driven by global liquidity. When money is cheap and risk assets are in demand, crypto thrives. When liquidity tightens, everything suffers, no matter how good the tech is. We've seen this pattern play out in every major cycle. In 2017, altcoins only exploded once Bitcoin had established strength and liquidity was flowing in. In 2021, the same thing happened again. The moment global markets pulled back, crypto pulled back even harder. And 2025 is no different. Narratives like the real-world assets, gaming, and meme coins all depend on the bigger picture of whether capital is flowing into risk-on assets. Right now, traditional finance is starting to blur into crypto with things like tokenized securities. Nasdaq itself has been exploring tokenized trading products, which could bring in more liquidity. But it also means more regulatory oversight and sudden shocks when rules change. If you're only watching your favorite altcoins chart, you'll miss the fact that these macro shifts set the stage for the entire market. So what's the actionable takeaway here? Pay attention to signals outside of your portfolio. Watch Bitcoin dominance, stablecoin flows, and global news around interest rates and tokenization. These are the breadcrumbs that tell you when risk appetite is high and when it's time to be cautious. If you understand the bigger picture, you're not just reacting to the market, you're actually anticipating it. So, to recap, here are the 7 mistakes to avoid this cycle. Chasing narratives too late, valuing price instead of market cap, leaving everything on one exchange, failing to take profits, following influencers blindly, overexposing yourself to one play, and ignoring the bigger picture. Remember, every single one of these mistakes has wiped out investors in past cycles, and they'll do the same again in 2025 if you're not careful. The difference is that now you know how to spot them and how to avoid them. Let me know down in the comments, which of these mistakes have you made before, and which one do you think is the most common this cycle? I'll be reading and replying to as many as I can. If you found this breakdown helpful, make sure to hit that subscribe button and ring the notification bell so you don't miss future crypto updates. Thanks for watching, and I'll see you in the next one.